So let me begin by welcoming you all to today's Green Talk Live. Today we'll explore, how the climate alignment of finance is evolving. That's a fantastic topic, but a complex one. And I am Mathilde Ménard. I'm the Deputy Director of the Environment Directorate at the OECD. And we all know, I guess if you're joining this seminar is because you're interested in the topic. So we all know that finance is central for achieving, the net zero emission and the climate resilience that we need. It's also a key driver of innovation, and it does contribute to strengthening energy security, which is a very topical topic these days. So last week, the OECD has published the second edition of its review on aligning finance with climate goals. This analysis takes stock of progress in aligning finance with climate goals. It is zooming in on both the existing policy playbooks and also the significant untapped investment opportunities that remain. So, and as we know, policy making and investment decisions aimed at advancing the climate transition and at reducing climate-related risks, and they must be anchored in robust evidence. So that's what we are trying to do with this review. It brings together the best available data and insights across three pillars. The first one is the implementation of climate-related financial sector policies. The second one is the tracking of the climate alignment of both financial, the developments in metrics and approaches and methodologies to assess this alignment. So the recently released last week, actually, second edition updates trends from the first edition published in 2024. It also addresses evidence gaps, and it displays further geographical granularity to highlight differences in approaches and opportunities. So building on these findings and drawing on perspective from various regions and segments of the financial system, our panelists will reflect on actions and opportunities for different actors and different contexts. So I'm very pleased to welcome you today. First, we'll have a presentation by the authors of the review, Raphael Jachning, the team lead and senior policy analyst, and Jolien Niels, economist and policy analyst at the Environment Directorate of the OECD. And then we'll have a fantastic row of panelists that will react to the report and tell us what they take from it. So we'll have Thomas Beretti from the Network for Greening the Financial System in GFS and Banque de France. We have Catriona Marshall from ComGest, Robert Patalano from the Center of Economic Transition Expertise, CITEX, in the London School of Economics, and Sylvia Ruprecht from the Swiss Federal Office of the Environment. Not in the right order, we'll see the order after the presentation. So for those of you that are joining online, you can send questions at any time during the event using the Q&A function in the Zoom. And we'll try to address this question at the end after the presentation and the panel. So that's why I asked the panelists to be not too long, even though I'm sure they have zillion things to say. But first, I give the floor to Raphael and Jolien to present the report in 10 minutes or so. Thanks.
Thank you very much, Mathilde. A warm welcome from our side as well. Jolien and I are very pleased to bring these findings to our audience today. Thank you for joining. A couple of words on my side to start with on the context, the policy context, just to flag that this work is a multi-year work program on the OECD side that is anchored in climate policy goals at international level, what you see at the top there with the Paris Agreement, but also very much so national level policy goals that relate to climate action. That's the starting point and the perspective that we take. As Mathilde mentioned, obviously, aligning finance and ensuring the transition of finance with climate policy goals comes with a lot of potential and actual co-benefits to other policy priorities. Mathilde mentioned energy security, but obviously increasing economic resilience and fostering innovation. Those are more than ever important co-benefits to have in mind in the current policy environment. And as Mathilde hinted on, all of these policy-making sort of decisions, but very much so on the investment side, require robust evidence. And that's where obviously the OECD has a role to play and plays a role in bringing about best available evidence in an environment that when we talk about the financial sector across asset classes, across in types of investors, types of financial instruments remains relatively scattered. And that's where the role of an institution like the OECD is relevant in bringing together information and best available information in a way that is as comparable and comprehensive as possible to help inform policymaking and investment decisions. The other quick thing I did want to mention as part of the framing is that obviously when we talk about the climate performance of finance, there are broadly speaking two perspectives. One, which is the one obviously we are taking from a climate policy perspective, which is about what is the contribution that finance at large brings to support climate policy objectives, or perhaps sometimes undermine them. And how can we move finance to contribute to climate policy goals? The other perspective is that of the financial sector, whether from an investment perspective or from a financial regulation perspective, more about the impact of climate change and climate risks on financial stability, financial bottom line, and so on. I think what we want all of us to have in mind is that there's, from an analytical perspective, from an evidence perspective, but also from an action perspective, there are actually overlaps and synergies between these two perspectives. And that is perhaps also why, as you will hear from Jolien in a minute, we try to bring about as much evidence as we can on the financial policy side of things to the discussion. And I'll leave it at that and let Jolien bring to you key insights to help inform our discussion today. Thank you very much.
Thank you, Raphael. So how aligned is finance with climate goal, and how is that evolving over time? Overall, we see that policymakers globally are pursuing different policy playbooks to unlock large, untapped opportunities to transition financial flows. And we observe really three key trends. First, on policies, we see that countries across geographies are expanding the number and the mix of climate-related financial sector policies, adopting different policy playbooks in doing so. Secondly, on the actual tracking of financial flows, we see that climate alignment has advanced for some financial flows, but large opportunities remain untapped to transition investments globally. And finally, when we look at the data to track the alignment of finance with climate goals and the effects of different policies, we see that this data is increasingly available, but gaps remain to identify transition opportunities and assess opaque financial asset classes. We'll break this down a bit more over the next 10 minutes or so, starting with looking at policies. When we do the analysis on policies, we really look at this divided into two different areas. On the one hand, you have real economy climate policies. And effective real economy climate policies really remain the fundamental levers for incentivizing climate-aligned investments. The OECD does a lot of work on these kind of policies in the context of the OECD Inclusive Forum on Carbon Mitigation Approaches and Climate Actions and Policy Measurement Framework. And we see that these are still expanding, although the pace is slowing down a bit. And there's a lot more evidence on the effects of these kind of policies. On the other hand, there are the climate-related financial sector policies, which have more of a policy objective that relates to financial stability, price stability, or financial market integrity. But the evidence on these kind of policies is more scarce. That's why we zoom in on this second area in this report. We see that policymakers have expanded the number and the mix of these financial sector policies that integrate climate considerations. And since the early 2000s, more than 860 of these kind of policies have been adopted in 111 countries and by EU institutions as well. We also see that even though there are some observations of policies being revised or perhaps being passed, over the last 2 years, these kind of policies have still grown by 25%. most of these policies come in the form of transparency policies. So that's what you see in the light blue here. These are your climate disclosure requirements, green taxonomies, green bond frameworks, for example. But also increasingly, prudential policies that integrate climate considerations are taking up a growing share, adding up to about 20% of the policy mix as of 2025. And that's what you see in the light purple. Finally, monetary policies that integrate climate considerations are very much still an emerging area and only add up to around 2% of the policy mix. So that's what we see at a global level. What do we see at a regional level? That's really where we can start observing how countries across geographies are adopting these different policy playbooks. And in this chart, you once again see the 3 policy areas that I just discussed with the same 3 colors, but broken down across these different geographies. So we can observe, for example, that Africa has a higher share of transparency policies in their policy mix. We can also break this further down by specific policy instrument. And there we can see, for example, for Eastern Asia and Oceania, the dark blue, which represent climate-related disclosure requirements, make up the largest share of their policy mix. Whereas, for example, in Europe and North America, the dark purple, which are climate stress tests and scenario analysis, make up the highest share of their policy mix compared to other geographies. So overall, we see a lot of different policies being adopted, but also still scope for countries to widen their policy mix, for example, by adopting more climate stress testing. So we've discussed a bit policies, what's actually happening in the climate alignment of financial flows. We see some advancements for some financial flows, but also diverging trends between the real economy and the financial system. Starting here by looking at the real economy. In this chart, you see in the green low carbon energy investments, in the brown fossil fuel investments, and in the gray a proxy of total investments in the real economy. On that basis, we can see that low carbon energy investments are about 7% of total investments in the real economy and clearly outpace fossil fuel investments, which will represent around 4%. When we look at the financial system, we have to look at it by different asset classes. So here in the chart, you see analysis for listed corporate equity, syndicated loans, corporate bonds, private markets, sovereign bonds. And when we look at the green parts, which represent the low carbon financing, they are typically at around 4 to 5%, whereas the brown bars there, which represent fossil fuel or some carbon intensive sectors, they represent around 6 to 7%. We also mainly see really large gray areas in these charts, and that really represents the fact that there are still a lot of question marks in terms of the actual climate alignment of all these financial asset classes, stocks, and flows. There is, for example, for private markets, not really sufficient data for us to make this assessment. For sovereign bonds, there are still a lot of question marks around the methodologies to assess climate alignment. As I said earlier, data is advancing, but still not fully sufficient. So that's where an area where governments, central banks, and financial supervisors could develop coordinated data frameworks to start filling some of these data gaps. But for now, we have taken an approach of looking at climate policy relevant sectors to start better understanding where are those transition opportunities. And we can really focus, for example, here on the blue bars in these charts, which are other energy and industrial sectors, which represents up to 30% of the mix there, where we see some large untapped investment opportunities to transition. That's at a global level. At a regional level, we can see the divergences between geographies, continents, partially reflecting their different economic structures, but also different climate transition needs in different sectors. But we can, for example, from the analysis here, see where we look at corporate bonds and syndicated loans across these different geographies. We can observe, for example, focusing on corporate bonds, which is the top bar in each of the charts for each region here, that green labeled corporate bond issuance in Africa, Europe, and parts of Asia Pacific actually is outpacing unlabeled corporate bonds to fossil fuels. So what can policymakers do, keeping all of this data that we put together in mind? In the report, we propose a range of policy actions, but here we summarize three. First, there are still lots of opportunities for countries to widen their policy mixes, including based on peer learning with other countries. And for example, climate stress testing expanding the scope of that could be one example. Secondly, countries can develop coordinated data frameworks across governments, financial supervisors, and central banks to fill some of those data gaps that we discussed. And finally, governments can strengthen the evaluation of the effects of these policies that we discussed, where there are still a lot of question marks, to inform some of the policy updates that they have in mind and that are happening.
Are you done, Yoli?
Yes, exactly.
Yes. Okay. Thank you. I mean, it's really a major undertaking to do a synthesis presentation of this report that is extremely rich. So now we'll go to the panel discussion, and I would like to go first to Catriona Marshall, who is the head of sustainable investment at Comgest. Catriona, are you here with us? I've seen you in the participants
I
list.
am indeed.
Yes.
Thank you, Mathilde.
Okay, nice seeing you, Catriona. So the report highlights the large untapped climate transition investment opportunities that remain in the public markets. So from your perspective of an asset management, where do you see the largest opportunities, and what could policymakers do more to remove constraints or like set the right incentives altogether?
Thank you. It's an excellent question, and there's so much that I could touch upon. So I'll try to be sparing and talk about 3 points. First, I'll just quickly say, so Comgest, we're a French-based but global asset manager with around 30 billion assets under management. Typically, there's a long-term responsible investment. So this aligns quite a lot with our approach. So I'll give it from this perspective. I'd like to just open as well with touching on something from the report, which is unsurprising for us as investors, but just that we still see fossil fuel financing outpacing low carbon financing across pretty much all asset classes, even as the real economy energy investments rising. So from my perspective as a listed equity asset manager, it's not a gap of lack of capital or investment appetite, but really on incentives and classification. In many cases, we have the available capital, but there are few frameworks to correctly challenge it. So my points will roughly relate to this, and I'll flag opportunities, but also where I think policymakers can harness those. So the first is on regulated returns to unlock grid and utilities capital. So the most immediately scalable opportunity that we see in public markets is regulated infrastructure. So that's grids, utilities, water, and energy networks. These are businesses that have contracted revenues, transparent balance sheets, and long duration cash flows that are a natural fit and actually are quite interesting to equity investors that want to orientate towards the transition. However, the constraints for us are that those frameworks to support regulated returns have not kept pace with the investment cycle. And we see now huge opportunities. So just to give you an idea of that scale, there's about $5.8 trillion of grid investment globally expected between 2026 and 2035. And about $1.1 trillion of that is just in Europe alone. So what we need is that rate setting and returns allowances in many jurisdictions can create an alignment of timing. So what I mean by that timing mismatch is at the moment, we don't have any of the returns allowances that would mean these would be beneficial investments for us in the next 5 years. So it means that earning visibility suffers, dividend capacity is uncertain, and equity valuations reflect that risk, which is an uncertainty that suppresses the appetite of investors for these industries. So on what policymakers can do, I think updating and focusing on the regulatory compacts, so that's the specific framework around these investments, so that utilities can earn a clear, timely return on transition-aligned capital expenditure. The UK's recent Ofgem reset is a really good example. So this move to higher multi-year capital expenditure allowances tied to net zero outcomes. I think this is a very useful model. So replicating that across European regulators would help unlock a much larger pool of long-term capital. And this typically isn't very costly for regulators and policymakers to do. It's just a structural reform that will align incentives for equity investors. And so the second point that I want to raise is on emerging markets, and specifically why European asset managers are not deploying as much capital there as the transition opportunities warrant. So the investment case is not so much a development argument here. These are markets where the transition is structurally important. So we see a lot of demand growth in clean energy, and we see discounts that frequently overstate actual fundamental risks. So, and there are a lot of beneficial elements from a valuation perspective, but the structural constraint is it limits on how European regulated asset managers can deploy capital here, fit in the classification frameworks. So to give an example, many emerging markets do have taxonomies. We have the ASEAN taxonomy is now in its 4th version. There is the China and EU Common Ground taxonomy. Brazil has launched its sustainable taxonomy in late 2025. So there is this architecture. However, the problem is that these frameworks use different technical screening criteria than the EU taxonomy, which remains the reference point and the standard for justifying the environmental credentials of sustainable investments in EU funds. So specifically for us, it's anything labeled Article 8, but other asset managers, Article 9 funds, when you need to have sustainable investments, we struggle to align these. So in practice, what this means is when you assess an emerging markets company for a sustainable investment methodology, you cannot source the specific data point or demonstrates that it fits with the EU taxonomy, which is the requirement for us. So typically we rely on estimates, and given that there's a lot of greenwashing liability for European asset managers, it can sometimes be a cost that we can't take to take that risk on an estimate. So this is a huge area that policymakers can address that gap. And I think having that mutual recognition between the EU taxonomy and any of the third-party equivalents would not just be a statement of interoperability, but it would be an operational framework that allows companies to be assessed and to be included in European asset manager funds. And so now that I've opened the door to the wish list of things for asset managers for the upcoming update of the SFDR regulation, I wanted to raise another point that fits on this. So the third is on opportunities related to SFDR 2.0 and specifically the new Article 7 transition category. So just as a brief recap, the Commission's November 2025 proposal on this introduced several new product categories. One of those is an Article 7 transition funds. And these are a very good vehicle for equity asset managers investing in companies with credible transition plans. I'll make a caveat that it's not just on climate, it is on sustainable transitions, but it fits very well with our climate objectives. But the design of it adds a huge problem that exacerbates already inconsistencies across labeling landscape in Europe and beyond. So today we have a patchwork of overlapping frameworks, SFDR, the EU taxonomy, independent labels like FNG and Lux Flag, and now the ESMA fund naming guidelines, each with their own eligibility criteria thresholds and exclusion lists that do not fully align with one another. In the proposed Article 7 exclusions, I'll give one example of what illustrates this. So there's a 1% hard coal revenue threshold. This is inherent from the climate transition benchmark regulation. And this has been designed for passive index products, not active engagement strategies or equity investors like ours. But the hypocrisy in that is if we look at met coal as a concrete example, which is a byproduct of streams of met coal processing and in mining, these actually have a direct and material climate benefit. So they supply critical inputs for electric arc furnace, steel making, and various other industries that are very important for climate transition. But under the current exclusion logic, a company with exposure on those activities is excluded from the Article 7 eligibility. So we cannot have these beneficial companies in those funds. So what policymakers...
I don't want to interrupt you, but could you come to a conclusion?
Yes,
Sorry,
actually, and here I am. So
yeah.
What policymakers can do on this is use the SFDR update to have a consistent approach on that labeling architecture so that we're not dealing with 8 or 9 regulations or one labeling requirements, but with one. So to conclude there, the opportunities are large. The capital is there, but what's missing is clarity on frameworks, on regulated returns, and on classifications to channel it correctly. Thanks, Mathilde.
Thank you, Katrina. Excellent message. And yes, indeed, the opportunities are huge. And you mentioned in particular green investment. That's an area where we do a lot of work on how to finance green investment. And you mentioned what are the challenges in terms of regulation and you know, like how to deal with this patchwork, as you called it. So that's an excellent entry into the discussion. Thanks for your perspective, Katriana. Now I would like to maybe give the floor to Thomas Beretti, head of the Banque de France Center for Climate and Nature and senior advisor to the head of the NGFS Secretariat. So Thomas, the report finds that climate-related financial sector policies have continued to expand. We have seen that in Yolin's presentation, with in particular prudential measures gaining ground, and climate-related monetary policies also being XFS. What is the role of these policies, and do you have 1 or 2 examples of such policies from your members in both developed and developing countries that you could share with us?
Thank you very much, Mathilde. Thank you for the kind invitation and introduction, and congratulations on the fantastic report. It's a pleasure to be speaking on behalf of the NGFS Secretariat. So I'll have my NGFS hat instead of the Banque de France one. So we don't have much time, you know, all of you that central bankers love numbers. So I'll provide a few numbers and hope they will illustrate my comments. Just a quick reminder on the NGFS. So you mentioned it, Mathilde, the Network for Greening the Financial System, which is now a global coalition of 152 central banks and supervisors with 24 international observers. The OECD is one of them, all public institutions, and we are not a standard setter. We are a coalition of the willing, although nowadays sometimes wheels are stronger than standards. So we could argue that we have some influence there. So to answer very directly the question there on the role of prudential and monetary policies, maybe just start by stating something quite obvious and simple that I'm sure everybody knows, but it's important to remind that integrating climate into prudential and monetary policies is before anything else a matter of carrying out our core mandates properly, making sure that we can do so continuously. Well, the economics are now well established. We know that delayed climate action leads to material economic and financial risks. This, for us, has an implication that it threatens our ability as central bankers, supervisors, to deliver on our price and financial stability mandate. So to give a concrete example, in our latest NGFS short-term scenarios, we show that under an adverse but plausible physical risk scenario, regional climate disasters could cause GDP losses of 6% in Asia, up to 12.5% in Africa over a 3 to 5 year horizon. So we are not in the tragedy of horizons anymore. This is well within the monetary policy and financial stability horizon. There's no question anymore among our community about the relevance of this phenomenon for central banks. And this, I would say, is the first element of positive evolution.
Yeah.
Coming to the report, I really welcome the very detailed and insightful analysis. We do observe indeed the same expansion of climate-related financial sector policies across our membership. If I were to take only two examples among the many that exist, perhaps one in the monetary policy area and the other in the prudential policy, one in the advanced economy and another one in a emerging economy. On the monetary policy side, one of the most, or maybe just a quick point there, because we see not many monetary policy policies being implemented. I think that if you take the overall financial policies, monetary policy will never be a very high number anyway. So we don't have many monetary policies per se. We have collateral frameworks, we have eligibility frameworks, and then I mean the rate setting activity is not in itself something that can be recorded among the policies. So just to put that into perspective, we will never get to a very high number there. But the ECB Governing Council decided in July 2025 to adapt its collateral framework. So this is the core of let's say the policies that you can observe, and starting next month, climate factor will be applied to certain individual assets on top of the regular eligibility assessment. So the goal there is to capture the climate-related financial risk within the collateral exposure of the European Central Bank. So it's not a green allocation measure. This is really a very minority dimension of monetary policy action among our membership. Maybe on the prudential policy side, most progress has been made on climate stress tests and transition plans. And a lot of progress has been made in the past few years, but there's still a lot of progress to make. These have become a core tool to manage climate risks. As the OECD itself highlights, the South African Reserve Bank's recent climate risk stress tests allowed supervisors to assess banks' internal climate risk management frameworks and stress testing capabilities, and identified where further data and methodology work was needed. So this illustrates well the dual purpose of climate stress tests. They help estimate potential losses, and they help also build an institutional expertise and embed climate risk into supervision. So the NGFS will work extensively in the next work cycle, 2 years, around making the most out of these exercises. Maybe I would also finish up with adding a practical perspective to complement the theoretical and conceptual analysis that is in the report regarding trade-offs and unintended consequences of capital charges, because I know that this is sometimes comes up as a limitation, and I'm very happy also to and fully concur with the analysis of a global asset manager. And thank you, Catriona, because I think that indeed from the central bank perspective, we also observe these limitations. So just to say, full agreement with the fact that capital charges need to faithfully reflect risks. But indeed, we need to be precise on how we calibrate that. So our role is really not to distort risk analysis to favor any socio-political outcome. We have to contribute to the proper assessment and management of financial risks, both climate and others. And so the real risk we run if capital rules are bent to favor certain assets or entities, irrespective of their financial soundness, is indeed that we end up with a financial crisis on top of the climate crisis. So just to say, there is a consensus among the NGFS community on the fact that Basel rules, always perfectible, not implemented consistently globally, but still they've made global banking systems safer and sounder, and that makes banks more able to finance long-term projects despite the many crises that we live. So it's important to not envisage prudential regulation in a trade-off with climate goals, but really in synergies. And I think Yolene there, beating the let's say the trade-off tragedy is also a challenge that we all have. So synergies instead of trade-offs there. So yeah, Key issue maybe also just to finish on that note is we note in our report on tailoring transition plans to realities of emerging markets and developing economies is that adaptation and physical risks weigh more heavily in emerging economies. And so this is maybe an area where we need to build capacities on this matter in risks in climate risk supervision to make also the prudential frameworks fit for purpose globally. So to sum it up, the OECD's evidence helps clarify what these policies are for, making sure that financial stability and price stability remain robust in the face of climate change, which is one of the preconditions also for the transition itself. There's no silver bullet in prudential regulation or monetary policy for aligning finance, but every actor has a part to play and should do it fully within their mandates.
Thank you very much, Thomas. And may I come back to remind your introductory points that it's within your core mandate and not the economics is well established. And it's something we shall repeat in today's political context. And indeed, the fact that the NGFS and the central banks are really integrating that in their core mandate is fundamental to push the agenda forward, and also to get, you say, to get wise on these trade-off synergies, etc. And as you say, not rock the boat. You know, we have all the Basel rules that are needed, and we don't want to damage the system that brings us financial stability, but we need to consolidate it so that there is synergies between the financial risks and the climate risks. And your last point also on the importance of not focusing for, at least for especially for the emerging economies and the adaptation aspect, because the adaptation risk and physical risk are more important. So we need to develop there. So thank you very much. And as I always say, I mean, having the word from the NGFS and the central banks is really making the conversation solid and advancing. So thank you very much. Now I would like to give the floor to Sylvia Ruprecht. Sylvia, you're the senior policy advisor at the Swiss Federal Office for the Environment. So I would like you to maybe reflect on all the policy messages that are complex and subtle and that have to be nuanced, you know, from this analysis, because it's not easy to derive directly, or we need to be very careful and balanced in how we derive policy messages from that. So for you, what are the most important policy messages that you take from this work?
Thanks a lot, Mathilde, and thanks also for the invitation. We appreciate very much that OECD is doing this review regularly, the second review period now. The report is very comprehensive, as you said, and everyone can take something out, but I will speak on behalf of my view, Switzerland's view. So we are not part of the European framework. So Catriona, I can't just take your recommendations into account when designing our policies, but still. So in my view, one of the most important messages to policymakers is we should be very clear of the main goal of our policies. Is it on transparency? Is it on financial risk mitigation? Of course, we can hope for overlaps and synergies, as Julien and Thomas said so nicely, but we also have to know that there are some trade-offs. When we just implicitly hope and even communicate that these transparency and financial risk mitigation policies directly lead to climate mitigation and climate goal aligned financial flows, we might not reach that goal, even not directly. And the report shows clearly, with no surprise, that there are these trade-offs, and that when we want to reach climate goal aligned flows and climate impact of financial market, then we might also consider that. And the same is laid out in the report for metrics, I think, very nicely, so that the metrics we use, we also should be very much aware what they explicitly track. Do they really track the alignment and the climate impact, or do we want to track other things? And because it often comes together, so what we measure then we are informed that way, and then we try to design these policies. So maybe to be a bit more concrete, what recommendations we like to take into account when we design future policies. Of course, it's to keep in mind what we said so far. So what is our main goal and what we implicitly hope for, and how this trajectory and this implementation will or could be reached. In Switzerland, we know transparency obligations for large financial institutions, not like in Europe. It's more principle based. They have to publish a transition plan, but they are free to use the methodology fitting for they propose. And in addition, we have voluntary action of the market, of the associations, with some further, mainly transparency requirements. We also have reporting obligations for larger banks and insurances on climate and nature financial risks. So we have the transparency policies, we have the financial risk policies. But what we really now try to do is to evaluate if these policies, but also the voluntary actions that a lot of financial institutions really undertake without policy incentives or steering, is that leading to climate goal alignment. So this year again, we do this test, and we really try to implement the OECD recommendation saying looking for empirical assessments on these effects, on the voluntary action and mandatory effects. And we also take into account what you recommend, to conduct scenario analysis and evidence-based assessments. So we try to track with metrics that really are technology-based, that really are asset level based, that really track what goes on the ground, to get a feeling how the action of financial institutions come together with the financial flows we see. And we also want to take into account the recommendation you said, provide practical implementation guidance to the different type of financial institutions, because of course we are aware that pension fund and asset owner has not the same possibilities than an asset manager, but together they of course have possibilities to also contribute to climate goals. So we really want for the further development to continuously evaluate our set of metrics, our indicators, to have a comprehensive picture of the climate contribution of our financial market, and also the design of future policies. But now it comes the caveat. We know that even if we are aware of the best policy design and the goal and the indicators, sometimes this is just not politically viable to implement, because we have different interests, different lobbyings, different also short-term interests maybe. So taking that into account, we nevertheless might end up with a second best opinion. Not only we, but I think also in other countries. But that's why these reports of the OECD are so important, and to also finger point on where the challenges are and where we can improve as policymakers. Thanks a lot.
Thank you, Sylvia. Thank you for ending on the political economy of the reform. It's we are we are all there these days. So it's important to have thank you for recognizing that this report could help in the current context, and for your developments about the trade of the tragedy of the trade-offs, as Thomas was mentioning, and what is the specific Swiss line in trying to advance on this agenda. Now, I would like to give the floor to Rob Patalano. You are the Executive Director of the Center for Economic Transition Expertise at the LSE. You know that the report proposes a set of policy actions to better align finance. And from your perspective, what actions should policymakers across advanced and emerging economies or developing economies, what actions they should prioritize? And how could they better connect climate-related real economy and financial sector policies? That's a bit a continuation of the conversation we had with Sylvia just before you. So how to make sure that we evolve towards a more coherent policy framework? Rob, you have the floor.
Great. Thank you so much, Mathilde, and thanks for having me on this virtual panel. First, I also want to say congratulations to the OECD for having this report published for a few reasons. One, because in this geopolitical environment, having such a comprehensive and clear report about where there's progress and where there's lack of progress, I think is badly needed. And it helps support conversations like this to really have specific discussions about where progress needs to be made. So thanks for that. And then also, I guess, pardon my Greek, but I will pick up on what Thomas and Sylvia have mentioned about tragedies to say, yes, we've moved on from the tragedy of the horizon, but I think central banks are going through a bit of what I would call the curse of Cassandra, where they now are empowered to talk about what they're seeing in terms of medium-term risks that are really severe risks and not only have macroeconomic impact, that are quite severe, but also it can clog monetary policy transmission, which is core to their mandate. And yet the political elite refuse to really hear the extent of those crises that are on the horizon and to take needed action. So your report helps create motivation for that. So let me talk about policies now. So again, I'm going to build on what Thomas said, and I have perhaps a little bit more degrees of freedom to urge additional action. First, monetary policy. I appreciate there's a traditional role, but frankly, climate stress is something new for monetary policy in terms of forecasting and in terms of policy action. We at CTEX are talking about the need for adaptive inflation targeting, which in a sense means more patience, particularly as you're getting energy shocks and climate severe weather events. Central banking needs to change in terms of its monetary policy implementation. And the reason for that, feel free to read our report about the details of it, but the reason for that is if monetary policy continues to act the way it has acted to past traditional crises, we will choke off the financing for the green transition and create a negative feedback loop in the years and decades to come, where monetary policy creates a higher real rate and makes it much harder to support either at the sovereign level or at the corporate level the financing for those transitions. And I'm sure Katrina probably is already seeing that in terms of her own investment strategy. The second issue, building on what Thomas had mentioned, was collateral. He rightly mentions ECB is really groundbreaking in terms of its new collateral policy. However, the policy only affects 2% of the 1.5 trillion of collateral. So the elephant in the room is really public debt. And it's politically sensitive, but nevertheless, within the primary mandate, central banks need to be embedding climate and this climate factor, climate risks, into public debt as well. So you can actually price leaders and laggards of sovereigns and of sub-sovereign debt. If you can do that across sovereign, across banking, across corporate, you are really influencing market pricing and you are addressing market failure. And if the 152 central banks that are NGFS members were to do this within their mandate, I can assure you this will help significantly address market failure, and it's within their mandate. So now I would lastly say that from central banking standpoint, I have a request for the OECD. I think one thing you're not quite looking at yet, and I would recommend that you do, is the fact that central banks now are under threat in terms of their independence, in part because of their incorporating climate and nature into their primary mandate as they should. And it would be interesting to track to see which central banks are actually having their independence eroded for actually doing their job. Turning now to fiscal, I have 2 points. First, strengthening carbon pricing across advanced and emerging market economies is needed. It's clear that it's needed, but I would just say, again, if you get the carbon pricing right, you move gradually to real economy actors who actually are paying within their own frameworks for risk-adjusted returns, who are paying to scale up financing. So, I mean, they really understand the cost, and therefore it's a natural trigger for them to move toward renewables. It's within their framework for shareholder value. So you're actually creating market incentives. And I say it's doubly important because in this geopolitical environment, otherwise you need regulation. And regulation is not going to move forward at the FSB, at the Basel Committee, at IOSCO. So it's very difficult otherwise until you get the carbon pricing right. And then secondly, to Katrina's point, I think this transition to renewables, it's simply not going to accelerate unless you deal with electricity grids. And she made excellent points about the regulatory environment. This needs to be transformed across advanced and emerging markets in different ways. It's country specific, but it's so critical that you unlock this. If you can't electrify the transition and build out the grid, even with a lot of the renewables, with offshore wind and with solar, you're not going to get the progress you need. And then it will be inevitable that the financing of fossil fuels will have to continue, particularly given the amount of demand for energy from AI. Very concerning. Then the other question you asked me, and I know my time is tight, but the other question you asked me is about connecting the real economy and financial sector policies in a coherent framework. A number of countries, as they're issuing their NDCs, are using sovereign investment, climate investment strategies to talk about at a very high level how they will do this. Some of it is about green bonds, transition bonds. Some of it is of their planning is about where they will invest, particularly in clean energy and about elements of the transition. And then, of course, you have taxonomies and you have corporate transition plans and bank transition plans. What's missing in the middle, and this is a big middle, is the sectoral transition plans and financing plans to turn these high-level, lofty goals, which we admire and more is needed, and the nuts and bolts of data collection and company-level transition. You need all of the middle. And in the UK, CTEX is helping the UK Net Zero Council actually create financing plans in partnership with the creation of industry-led sectoral transition plans to make it very clear what the government will need to do, what the National Wealth Fund needs to do, what blended finance needs to do, so that capital markets, who are kind of at the end of the value chain here, have confidence that we're going to be commercializing the technologies and we're going to have viability in terms of these sectoral plans so that you can get a real risk-adjusted return on CapEx investing in the transition. This is a green growth strategy, and there's so much literature saying this can work if you get the policies right. And governments increasingly know this, and it's wonderful to see some countries around the world, again, irrespective of the geopolitics, they're making progress. And we're all on this call trying to help these governments do more. So I commend the OECD for doing that, and we're there with you to try and help that. So I guess with that, I would say, lastly, the governments can better articulate how they can pursue broader blended finance initiatives. Kudos to the European Commission for having a clean energy investment strategy that's trying to bring public, blended finance, and crowd in private sector capital. More needs to be done there to articulate how that works in practice, because as you know, with the OECD, blended finance conference day in and day out for the past 10 years has not scaled up blended finance, particularly in emerging markets. And I think turning really good ideas and good discussions into action takes more concerted steps. So I would encourage you as well, as you're doing your analysis of what works and what doesn't, trying to turn that into policies and really pushing the committees at the OECD to make progress in those areas. I'll leave it there. Thanks, Mathilde.
Thank you, Rob, and thank you for. Can you hear me? Yes. And thank you for putting on the table sort of additional points. The independence of the central bank is an important one, definitely. Also, your point on the carbon pricing, that's something that we are working on at the OECD. And I remember that we have been working on that for long. I remember the previous Secretary General who used to say, what we need is big, fat carbon prices, you know. Your point also on the electricity grid, financing for that. We are doing a lot of work at the OECD within the CEFIM program, you know, that's very important. And then last point, maybe we need to do more on that, the financing plans for the sectoral pathway transition plans. So thank you all for your super interesting contributions. We have 6 minutes left for Q&A. I have 1 or 2 questions that I would like to ask you. Let me go to my notes. So we have one question from Hassan Akbulut. I will read it. While the OECD highlights that developing countries and underdeveloped countries lead in the relative growth rate of green labeled bond issuance, the actual capital volumes remain critically low compared to advanced markets. So what actions and mechanisms could increase absolute volume of private transition finance into emerging markets? That's one question, probably for our panelists. I don't know who would like to take it. Let me read 2 other questions and you will choose which one you want to answer. So the second question is from Nasrin Bano. Why are assessments typically mitigation more focused? Is resilience and adaptation less relevant, or what is missing for assessment in this area? And the third question, and then I will give you like 1.5 minutes each. How can climate-aligned finance move beyond reporting and become a real driver of continuous improvement? From Sergio Titilo. So 3 questions. Who wants to answer the first one? Rob, you have 1 minute and a half.
Great. Can you hear me?
Yeah.
Okay, great. So look, I will address, we were a bit agnostic, but now I'll go right into emerging markets and developing economies. So blended finance is even more critical there, and it's critical for a few reasons. One, fiscal constraints and high debt levels means governments have less room to spend, and they really need to crowd in private capital. And as Katrina was saying, there's a massive amount of private capital if you make these deals bankable for them to come in and to scale up, but they're not. So you need blended finance, and you need the right policies and regulatory regimes to do so, from taxonomies to having government policies that are investor friendly, and the right structures. So something just I think this is helpful. There are a few challenges. One is that credit rating agencies and how they rate blended finance structures. It's really convoluted, and there are different methodologies that they're applying. And we have a blended finance lab to try and bring light to that. And we have a sandbox to actually bring deals from emerging markets into this sandbox to get credit rating agencies and lawyers and arrangers and asset managers and asset owners together to say, how can we make this work? How can we create solutions to make this work at scale? And how can we make it replicated in individual countries to try and bring more capital in at a reasonable cost of capital? So I think that another challenge is the cost of capital is constrained because there is a perception. It's a bit of behavioral finance and a bit of some high-level, high-profile defaults. But institutional investors are still very nervous about emerging markets. And the current credit risk premium in emerging markets is really just not appropriate relative to the past. And we're doing more work using the GEMS database to try and create more analytical basis for the fact that the credit experiences actually should lead you to a lower cost of capital in the future. Mathilde, I know my time is limited, so I'll leave it there. There are challenges that are identified, and there are solutions that are coming forward.
Thank you, Rob. The next question about why there are not so much assessment on the adaptation resilience side. So who would like to answer this question? What is missing there? Sylvia, yeah, please.
Thanks a lot. So maybe I can start with one perspective. So what I believe when you look at mitigation, we see through the different asset classes that the financial market actors can have a quite direct impact when we look at real estate, for example, or a huge impact via investments. When you look at resilience, it's always the question on what are we talking about? Is it again financial risk, so mitigation? So is it this resilience, or is it really the resilience of the world, of the society? Because when we look at what is needed there, and where money is needed there, it's often a question of public-private partnership, blended finance, and not private markets alone. Why do I come to that conclusion? I was at the OECD NGFS event recently, very great event, and there Brasilia was talking about new data, just spatial data on huge rivers that the flooding risk is expanding much more. And so I was asking, okay, what central bankers and insurances, what are you doing with that information? How does that influence your policies? And the question was more or less, it's a pricing mechanism that will influence, that will be different. So what I interpreted from that is like, okay, maybe the houses there will not have more insurance or no credits anymore, but it's not what I mean by resilience for the whole society and the environment, because I think that was also one answer, there a public-private partnership mechanism should come into place. And I think that's why it's again, be clear what you talk about and be clear what the goal is. And therefore, I think, it's important to also develop this field, but also to be clear how to reach to what goal.
Thank you very much. I'm afraid we have to wrap up now because we are reaching the time limit, but I would like to give the floor to each panelist for you to give us one sentence, what you take from this conversation to reflect further or in your work, whatever it is, in terms of policy making. Begin by Thomas. One sentence. What do you take from this conversation, please? Yes, Thomas.
Thank you, Mathilde. Thank you. No, yeah, just very interesting. I think that there is at least one area of alignment which is among the speakers today. So that's a good thing. I mean, all these challenges they show that things are moving, but they're moving too slowly and in a too scattered way. So the evidence is piling up on the merits of moving to net zero. We have a note that went out for the G7, the NGFS, on 31 case studies about extreme weather events. So, talking about the syndrome of Cassandra here, I mean, these events, these cases, they've been put on the table. They've triggered a discussion at the international level. So there is scope for action, although it's difficult. That's not an excuse for inaction. And on maybe just an answer on the central bank policies, we do have a report also that's coming out next week on monetary policy strategy, which I think will also shed some light about some of the aspects that Rob was mentioning, which is very important, and will tell you the trade-offs also in terms of collateral strategy. Having a collateral policy is only relevant where you have scope for intervention at the monetary policy stage. Typically, this is not a moment, to increase collateral in the central banking balance sheet. So all these aspects, they are certainly not a reason for inaction. Quite the opposite, but they will shed light and allow to better understand, what trade-offs and synergies are available to central bankers and supervisors. And indeed, I mean, this ecosystem discussion that the OECD is facilitating, this is great to hear the perspectives of each actor.
Thank you. The only problem we have is time. So maybe Catriona, really one sentence or two max, please.
Yes. So I think what I hear across the board is that there's not a lack of ambition. There's just a fundamental coordination problem in many areas. So I think this has led us to a low ambition equilibrium. So what I'll say from this is that we need to prioritize the areas that really matter, that help price in the risks and opportunities. So for me, of course, from my perspective, I see that very much in aligning metrics, aligning frameworks, making sure that those metrics do what they say they do. And I think the second is a point that Rob raised about carbon pricing. This will ricochet across various areas of economies in the financial system. And it is one that even just having it in a cross-section of countries is so important. And that's an incredible lever. So that's another area. Thanks.
Thank you, Catriona. Maybe Sylvia? Quickly, please.
Yeah, thank you. So, yeah, I think many things are already said. So the ambition is there. It's urgent. We know that it's urgent. It's not becoming less urgent. So many good different approaches out there. But I think we really have to target it more and implement it and do the next step and really advance.
Thank you, Sylvia. And Rob, you have the last word.
The cost of inaction is increasingly costly for governments and for societies, and OECDs are very well placed with these types of reports to document the growing costs of inaction. We've heard some level of action. We also know that many more actions are available now within mandates, and the evidence base is increasingly there and going up to the G7 and G20. So documenting action, urging action within mandates. And lastly, listening to the private sector, to markets, because as we know, scaling up 1.3 trillion per year in climate finance is enormous. And when markets, Katrina is a great example, continues to say we need X, Y, and Z to happen from policymakers in order for us to scale up, we need to start taking action to take that seriously. Thanks.
Thank you. So I cannot summarize better than you did, but I would just repeat. We are moving too slowly, in a too scattered way. So we need more coordination. We need more targeting, more implementation. We need to prioritize better. We need to work on carbon pricing. And cost of inaction is huge. So thank you all. It was a fantastic conversation. Thank you to Yulene and Raphael for presenting the great report. And I wish we had 3 hours to discuss it, but that's the way it is. So let me now announce the next Green Talk Live. It will be next week on the topic of scaling water security investments through bond markets. So it's kind of a, continuation of this discussion on a specific sector, a specific risk. So we hope to see you all there on the 9th of July. And thank you again, all of you. It was a fantastic discussion. And most of you, I guess I will see you next week in London. So see you next week in London.
Next week.
Thank you.
Well, thank you.
Thank you very much.